Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Well, our next guest follows the U.S. economy, really the global economy, has for decades, weighing in on the trends that describe us and divide us financially, economically, and so much more. Let's get to the interview this hour. With us is Nobel Laureate, economist, and Columbia professor Joseph Stiglitz. He was an economic advisor to presidents, including chair of the Council of Economic Advisors. That was during the Clinton administration. Former chief economist at the World Bank. He's written numerous books and research papers. His latest book, The Road to Freedom, Economics and the Good Society. He joins us here in New York City. Professor Stiglitz, so great to be talking with you once again. It's been a while, but great to have you here. And we want to talk about the book, but we would be remiss not to ask you your take on today's economic environment and the stickiness of inflation. What is the smart conversation that you think we should all be having here at Bloomberg when it comes to today's U.S. economic environment?
From the point of view of economics, having 2.5 or even 3% inflation is not a big deal. You know, the 2% target was pulled out of thin air. It was not based on economic science. What we want to be sure of is that we don't have runaway inflation. And inflation has clearly been tamed. It's been brought down. It's stable. It fluctuates from month to month. But it is not a major problem. We should be focusing on other things, continuing economic growth, making sure that all Americans share in that growth. Those are the kinds of things that we ought to be thinking more about.
So, Professor Stiglitz, should the Fed abandon the 2% inflation goal? Should they have a different inflation goal, a different metric that they should be held accountable to?
Yes, I think they should. I think they should be talking about keeping it within a range, 2 to maybe 3.5%, 4%. You know, there's actually some economic science that says, especially in a time of major structural change, such as we're going through, having a little higher inflation actually is helpful in reallocating resources in the presence of downward nominal rigidities of wages. Because what guides the movement of resources from one place to another is relative wages. And if some wages are sticky downward, you want other wages to go up enough to move labor. And that means you're going to have more inflation. So actually, a little higher inflation is actually good for the economy.
Do you think the Fed's management of the economy has been a good one in terms of policy?
Quite frankly, no.
Okay.
To put it bluntly, let's go back to when inflation broke out after the pandemic and the Russian invasion of Ukraine. The question was, what was the cause, the primary cause of the inflation? It was unambiguous. It was the pandemic and war-related interruptions in supply chains, rising prices caused by shortages of oil and food. It was demand shifts. People wanted to live in different places. And that meant housing prices went up where there was a scarcity, but didn't go down as much where there was where people didn't want to live, like in parts of New York. Raising interest rates actually impedes the ability of the economy to respond to that kind of structural, to that kind of challenge. We needed to build more houses in the places where there was a scarcity. And having higher interest rates actually makes it more difficult. They also have a model of the economy that's based on competition. That might have been true some time ago, but we have an economy with a lot of market power. And firms are trading off. If they raise their prices, they get more profits today. They lose profits in the future. And in that trade-off, when you raise the interest rate, they value those future losses less, and they're induced to raise their prices more. So margins go up. And a marked aspect of the inflation that we've just been through is that markets have increased enormously.
Hey, Professor Stiglitz, I just wanted to, speaking of the Fed, Carol, I know you had a.
Well, one thing before we have a bigger, broader question that's certainly been
Carol's
a big
eager
thing.
to jump in on this.
Well, but do you think then we should be cutting rates already, that we're behind the curve right now?
Yes, I think the risks are asymmetric. I think with Europe already slowing down in recession, we don't know where China is going to be going. I think prudence would have us going back to a more normal interest rate.
Yeah.
The higher interest rates are really not going to be taming inflation. The Fed model was wrong in another way. They dramatically had said that we're going to need 5% of inflation for 5% unemployment for some time in order to get inflation down. They were absolutely wrong. We got inflation down where in a period where we kept unemployment relatively low. So their analysis of the economy was just off. And meanwhile, they have put at risk our banking system. We had a problem in Silicon Valley Bank, partly because of the enormous changes in term structure, which their policies led to. And we're facing a debt crisis in the developing countries and emerging markets. So there's enormous one-sided risk, I believe, in the policies that they've been pursuing.
Well, on the Fed, Professor Stiglitz, I got to ask you about this Wall Street Journal report that broke last night that said how former Trump administration officials are coming up with plans to take on the independence of the Federal Reserve, essentially at one end of the spectrum, even allowing, if President Trump gets reelected, him to weigh in on Fed policy when it comes to interest rates. Talk a little bit about your reaction to if this were to come to fruition, how important the independence of the Fed is, and if that would really put at risk the model of the independence of the U.S. financial system.
Well, I think Trump is himself a major argument why you want to have independence of the Fed. You don't want somebody who doesn't understand monetary policy, who would put at risk the long-run stability of the economy for the short-term electoral advantage of having a hot economy right before an election. That's precisely why there is an argument for independence. So, I believe in accountability of the Fed. It is a public institution. We had previous chairmen of the Fed were very cognizant of that. I remember Paul Volcker saying, Congress created us and Congress can uncreate us. So there is a kind of accountability that responsible heads of the Fed understand, but we certainly don't want Donald Trump to be running monetary policy.
All right, we do want to dig into your book because you've been thinking a lot about the meaning of freedom, and I think we throw the word around a lot. I think the folks who created the United States, our founding fathers, thought about freedom a lot. And the difference, though, between what that really means, and maybe it comes down to, as you think about it, the values that we all have in society. Tell us about how we need to kind of maybe redefine freedom and what it means in terms of citizens more broadly and generally, as well as economically, in terms of their success.
Sure. I approach the issue, obviously, as an economist. Mm-hmm. And as an economist, we think of freedom as free to do, what you can do, what are the choices that you can make. Somebody who is at the point of starvation doesn't really have any freedom. He has to do what he can to survive. And so expanding the set of choices that an individual is available is a way of saying that he has more freedom. And here there are a couple of ideas I put forward in my book. The first is that in our integrated urban 21st century economy, what one person does, the expansion of his freedom may lead to less freedom of others. Isaiah Berlin, the great Oxford philosopher, put it this way. He said, freedom for the wolves has often meant death for the sheep. And in the context of the U.S., for instance, freedom to carry an AK-47 means that people will die, and it means that our school children are not free from fear. They have to learn what to do if a gunman comes into the classroom, and teachers have to go to school worried about whether they'll be attacked. Freedom not to wear a mask is taking away the freedom of others to live. So we have to balance these freedoms. There are trade-offs. In many cases, those trade-offs are easy. Freedom to pollute takes away the freedom to have somebody with asthma to even live, let alone the freedom of all of us to live on our planet. So there, I think we have to constrain the freedom of the polluters and the freedom of the exploiters.
So we're talking with Joseph Stiglitz, Nobel laureate economist, professor of economics at Columbia University, and we're talking about his new book, The Road to Freedom, Economics in the Good Society. All right, so if we rethink, Professor Stiglitz, the idea of freedom, so it's maybe more inclusive or it's a broader definition, how do we do that within society with corporations? The need to be profitable for those, we're in earnings season. We look at companies and their reports, and that's how we kind of measure them, grade them. What does government need to do? How can we maybe be better, if you will, for more?
Well, first, let me emphasize that in the world I've just described, there's an important role for regulations. Corporations often don't like that, but we have to remember the purpose of our economy is to improve the lives and livelihoods of our citizens. It's not the other way around, that the economy is supposed to serve society, not the other way around. There's another aspect. Regulations can actually expand the freedom of all of us. Think about stoplights. If we don't have stoplights, we have gridlock. None of us has the freedom to move. Stoplights, which are a little bit of coercion, mean that I have to take turns. But by taking turns, we all have more freedom. And that basic idea extends much more broadly. People don't like to pay taxes. They often feel kind of coercion. But when those tax revenues are used productively, like they were to invest in the internet and invest in the mRNA platform that led to the vaccine against COVID-19, that expands our freedom to do.
Right.
And so we have to look at this in a little bit more holistic way.
Well, I want to go to your taxes point, because I'm curious if you could wave a magic wand or implement some sort of tax policy here in the U.S. What would it be? How could you reinvent it? Would you broaden the tax base? Would you lean more on corporate taxes? Would you tax wealth more? What, in your opinion, would work?
Well, I begin by analyzing what are some of the key problems our society faces. And one of them is inequality. One of the reasons, and a second problem is the growth of market power, which has been enormous in the last few decades. And those two are obviously linked. When you have more market power, the fruits of that market power go to those at the top. We also have more, what economists call monopsony power. Mm-hmm. Firms have market power over workers and have driven down their wages significantly below a competitive level. So I want to have more antitrust policy, more competitive labor market policies, but that's going to take time. In the meanwhile, there's a lot of monopoly rents. And so part of what I would begin by doing is increasing corporate profits taxes, which are not a tax on return to capital. Mm-hmm. They are a tax on this monopoly profits. I'd also like to have environmental taxes. Firms that are engaged in polluting the environment ought to pay for the damage that they're doing. Remarkably, America, those at the top pay a lower percentage of their taxes than those down below. Even some of our richest people have commented that they think that's
Right.
morally wrong.
Well, can I ask you, like on a day when we're looking at a company, and forgive me, I'm just singling out because it popped, shares of Alphabet are now a $2 trillion market cap company. This week, next week, last week, we've been obsessed with certainly what we call the Magnificent Seven, the big mega cap tech companies. They're very big. Amazon, we talked with an author recently, so entrenched certainly in our world, and you think about their reach. Are these the companies, the individuals, whether it's an Amazon, whether it's a Meta, whether it's an Alphabet, that you think, you talk about growth of market power, is it too much at this point, in your view, that something needs to be done to rein them in, or do the benefits outweigh the downside here?
Well, they do give benefits, but they have a lot of downsides. They need to be better regulated. Europe has done a better job at regulating them. The digital harms are quite obvious and have been by now well documented. But talking narrowly now about market power, I think we ought to do what we can to limit their market power, but tax the fruits of that market power, the revenues that they get, at a much higher rate. If you ask the question, would Jeff Bezos or the founders of Google or Zuckerberg stop working if we tax their wealth in a way, say, of 3%? And the answer is obvious. They would continue to work.
But do you think that they would leave the United States?
Well, we have imposed what we call an exit tax, that those with a lot of wealth and who don't feel loyalty to the United States can leave. We allow them to leave, but they have to pay a tax that represents a tax on the fruits of the wealth that they've accumulated while they've been in the United States. And that tax is significant and it is a deterrent. And if it's not, it may be that we ought to consider raising that tax. But I don't think people like Zuckerberg, Musk are going to leave the United States. They realize the benefits of American citizenship.
We're speaking right now with Professor Joseph Stiglitz, Nobel Laureate economist. He's a professor of economics at Columbia University. He's got a new book out, The Road to Freedom, Economics and the Good Society. Professor, as I mentioned, you are up at Columbia. You've been there for a long time. We've been watching everything that's been happening on the campus there, as well as campuses including USC, Yale, MIT. The list continues to go on here in the United States as we've seen pro-Palestinian protests and encampments take over some of these campuses. Freedom in the academic context. How are you looking at the protests in the context of freedom of speech?
That's a good question. I mean, first let me comment that up at where my office is, which is the Manhattanville campus, things are very quiet.
Near the business school.
At the business school.
Yeah, quiet there.
But you've been on campus a long time, and you've seen different protests over the years, and it seemed to be, I was there when there were protests, and it seems like that's what students should be doing, exploring and pushing back when they don't feel like things are right. But what is it, those protests in the context of freedom of speech?
So I agree with you very strongly. I'm actually happy the students are engaged in the world. That's one of the things I try to get them to be interested in the world, and also to reason about the world, to come to understand it, and to debate how could or should things be changed. So that's a good thing. And in my own life, protests have played a very important role. Back in 1963, I was down there in the March on Washington with Martin Luther King. And, that speech he gave about I have a dream has been a lifelong inspiration to me. So even civil disobedience in certain circumstances can be an important mechanism for social change. We have a special responsibility, of course, to make sure on our campus that all views get heard, that we can have civil debates. And so on the one hand, academic freedom is really important. And I really took offense to Speaker Johnson coming up to our campus and calling for the resignation of our president. I hadn't seen anything like that, maybe since the HUAC hearings, the House Un-American Activities Committee back with McCarthy in the 50s. Wow. I mean, that kind of direct interference in academia is just unheard of. And we know some of the Republicans have been trying to undermine universities because universities teach children how to, our youngsters, our young men and women, how to think. And a lot of people don't like that idea that they should be thinking for themselves. But at the same time, we have to create on campus a community where all voices are heard. And I think we're actually working very much towards that. There were only a few people raising problems. And I think having outside agitators like the speaker is not helpful.
We're going to leave it on that note. We always appreciate hearing, you talk about hearing from voices. We always appreciate hearing from you. Professor Stiglitz, thank you so much. Nobel laureate economist, Columbia professor Joseph Stiglitz here in New York City. Check out his book, his latest book, The Road to Freedom, Economics in the Good Society. Really appreciate spending some time with you.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Intel shares, folks, they are down the most in not quite 4 years, but they're still down about 9.5% here. This is after the company gave a lackluster forecast for the current period. And turning this giant, Tim, as we find out, they're in the midst of a turnaround. It's not turning out to be so easy. Yeah,
in fact, here's Intel CEO Pat Gelsinger on the good and the better to come. He joined Bloomberg TV and radio a little earlier today. Check it out.
We delivered a solid Q1, right? We met on revenue. We, beat on earnings, a bit tepid in the first half, as we said, but we see a lot of, improvement as we go through the year. And with that, obviously, the foundry business, as I would say, we're going to see progress on the foundry business every quarter from now to the end of the decade.
That's Pat Gelsinger, Intel CEO, earlier on Bloomberg TV and radio. With more on the company's business and planned turnaround, back with us is Bloomberg News U.S. semiconductor and networking reporter in our San Francisco bureau, Ian King. So, Ian, the quarter, what occupies you the most on the release and then after the call with analysts yesterday? Because as Carol mentioned, the reaction to the report, at least when it comes to the stock, was really swift.
Yeah, I think the quote you played from Pat is relevant here. I mean, you've got a man who hasn't been back at Intel for that long, putting a long-term plan together, trying to repair the mistakes made over a decade. Though that plan won't pay off anytime soon, but in the meantime, he's having to give quarterly earnings, and anything that's kind of lackluster, as the forecast was yesterday, is going to cause concern, and that this long-term plan isn't going to pay off. So he's selling a bright future while talking about a kind of lackluster interim period.
It makes me think about, like, every once in a while, I bet a company would just be like, can we just go public for a few years and kind of clear things out, do the reboot, and then we'll come back to the public markets. We've seen it before, but I almost feel like potentially, Ian, that's what Intel needs right now.
Yeah, I mean, that's definitely something that's been talked about by, people who sort of look at Intel and where they are, and that's, that's the position they're in. As we've said, that, there's going to have to be significant changes, not just at Intel, but in this semiconductor industry in general, for this big plan to pay off. The analysts like the strategy, say he's pressing the right buttons, but again, so many variables, so many things have to go right for everything to pay off and Intel become at the level it used to be at.
One thing I want to ask you, I mean, the foundry business, it's an expensive one, right? I just talked with some investment folks. I was planning for a panel that I'm going to be doing in a couple of weeks. They have lots of money to invest. And one of the themes that was top of mind was reshoring and the amount of money that they need to invest, the capital spend that we are seeing in the likes of things like semiconductors and the industrial space, as a lot of countries, including the United States, are bringing things back home. It's real. And some of it has to do with climate change and, you know, companies trying to kind of clean up their supply chains. And so closer manufacturers help them do this. This foundry focus, will it pay off in the long run or TBD?
It's very much a TBD. I mean, as you said, there's a geographical trend here. Intel is building plants in the US. But guess what? So is Samsung. Guess what? So is TSMC. If you are out in the market for somebody to make your chips, who are you going to go to right now? We need to remember that Intel is giving over 30% of its high-end business to TSMC because its plants aren't good enough right now. Obviously, they plan to change that. Obviously, they plan to reverse that. But again, that's still at the kind of planning implementation phase. So even if you trusted Intel with your crown jewels, why would you do that right now? And that's the problem.
I mean, you mentioned that the CEO, Pat Gelsinger, hasn't been back at Intel for very long. He got back there in February of 2021 when he embarked on this turnaround. I'm wondering about patience that investors have. Based on the folks you talk to, your sources, what kind of patience or timeline or runway are they giving Gelsinger here?
Well, I think you just have to look at the stock performance. I mean, this year they are second worst performer on the Philadelphia Semiconductor Index. That's not a good recommendation. That's not people excited about his company. And you know, all of the reports, all of the notes say exactly the same thing, which is why would you choose to own Intel right now? And the answer is you probably wouldn't. So that's a struggle that he's going to face. How that manifests itself, how the board think about that, we don't know yet.
All right. It's still almost $135 billion market cap company. Nothing to sneeze at. So what is the value that is Intel at this point?
Well, the value is they are an incumbent still. If you're going to make a standard industry server, you're going to use an Intel Xeon. If you're going to make a PC, more than likely you're going to use one of their core processors. So that, you know, there's still a lot of value there. If they can get the manufacturing back to anything like the level that they used to be at, that's a tremendous asset. Very few companies in the world can actually do that. So all of these things, again, if they manifest themselves in the right direction, are valuable. The problem is, you know, he talked yesterday about, oh, we're getting into the accelerator market. We're going to have $500 billion of fresh revenue from this new product we've got. And again, that's great. But then you have to compare it to where you might put money. AMD is going to have $3.5 billion from that exact same market. And guess what? This year, if analysts are right, NVIDIA is going to have a $96 billion market. So that's $96 billion versus $500 million. Who are you going to choose?
Who do you compare Intel against? Last question.
Sorry, say that again. Sorry.
Who do you compare Intel against? Like, I just think about it. Like, we always talk with you that there's a lot of different names, you know, that make up the SOCs in the chip space, and they're not all the same thing. So who do you compare Intel against at this point? Is it AMD? Is it, like, who is it?
Well, you'd have to compare them to a combination of AMD or NVIDIA and TSMC.
Okay. And
by any metric, they just don't measure up right now.
How much more time does Gelsinger have? I lied. I had one more question for you. How much more time, Ian, do you think Gelsinger has? And is he the right guy to do it?
Like I say, everybody who, you know, all of the analysts say, yes, he's got the right plan. Some of them are concerned that he was put in place too late, that things had gone too far. According to what the timeline he's setting out, Intel should be back in the lead in manufacturing next year. That is going to be the real tipping point, the real point where, hey, Intel is back and things are going to start to work in their favor. So sometime next year, he's either going to be right or we're going to be looking at him and saying, hey, Pat, you told us and you're not there. I think that will be a significant point for both his tenure and also for Intel's future.
In a sign of the times, Intel down almost 10%. I'm looking at the stocks. It's actually up, folks, 2.5% today. And a lot of it is NVIDIA. It is an outperformer. And this is on all the AI excitement, again, coming off of Alphabet and Microsoft.
Intel down 37% so far this year. Ian King, Bloomberg News U.S. Semiconductor and Networking reporter, joining us from San Francisco. Check out all his stuff on Intel.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Last year in the U.S., startups founded exclusively by women accounted for only 2% of all funding that was invested in VC-backed startups. This, according to the World Economic Forum, citing data from PitchBook. In Europe, Carol, the numbers were even worse. Only 1.8% of the capital raised went to female-founded startups.
All right, so that's how things look when it comes to venture capital. But what about earlier in the fundraising process? How are things looking when it comes to angel investing? Back with us to talk about it with an update, Ann Corkran. She is co-chief executive officer and managing partner at Golden Seeds. Just a reminder, they're a network of angel investors exclusively investing in early-stage women-led companies, and she is joining us from New York City. Joanne, good to have you back with us. It's been a little bit of a while, 1.5 years. A lot can happen, certainly. A lot has happened, I feel like, in the market environment, the business environment, the funding environment. Tell us what's changed since we last talked.
Okay, so let's talk about the markets overall in the U.S. first. So 2023 was a pretty difficult funding environment. Venture capital annual volumes were down, 35% from the previous year, and that was down from the year before that. So, but the good thing is that last quarter, those flows were back close to the pace of which they were running for a decade, the pace of 2017-18 before those crazy run-ups. So that's good. Angel volumes, angels were also cautious. When you think about it, many angel investors already have investments. They already have a portfolio. And so many of those people pulled back on investments last year because they had to keep their powder dry, because angels are dependent on follow-on rounds from venture. So while venture is clogged, angels have to be cautious. So far in this year, the first quarter of this year, we are seeing some signs that things are improving, or maybe I should say it this way, they're not getting any worse. So of course we have to consider all the variables.
I'm surprised. Yeah, I'm surprised you're not saying that things are getting better. We've seen a couple of high-profile tech IPOs in recent weeks. Why do you think things aren't necessarily getting better from at least an angel perspective?
Well,
is it rates? Is it all rates?
If things just hold here, that's pretty good, because for the last 2 years, things have been getting worse and worse. I don't need for things to get a lot better from here. I just need things to stabilize, right? Because then we could go back to business. If you think about it, our companies, we're still telling them they need a plan A, B, and C, because they can't depend on getting an easy A round or B round out of venture right now. Venture's still digesting losses. A lot of venture funds are still digesting losses. So I don't want to say it's gloomy like it was the last couple of years.
Yeah.
But we need a few more quarters to feel like we're back at a consistent run rate of investment.
You definitely sound subdued a little bit, like and concerned. What is not happening as a result of the environment that maybe concerns you in terms of, especially when it comes to women-led investments at that very, very early stage?
Well, some good things have happened for women in the angel markets. Okay. I mean, the last 20 years since Golden Seed started has been phenomenally good for women in the angel markets. 20 years ago, women got 3% of the capital. Now, women founders and co-founders get about 40% of the angel capital. And the most important thing is that the yield, the percentage of companies that seek funding that actually get it's just about comparable now for male and female entrepreneurs in the angel market. So that's really great progress in the angel markets. And why did that happen? I think a lot of the reason for that is that angels in the US, individuals who invest in startup companies, about 40% of those people are now women. And that's up, about, more than 10 times since when we started in 2004. So that's really great.
Hey, Joanne, I just want to jump in. We don't have a ton of time in it, so I want to jump in here. As I mentioned, it's Golden Seed is a network of angel investors that exclusively invests in early stage women-led companies. I would imagine somebody listening right now might have the question, from a returns perspective, if you're trying to maximize returns, why would you restrict yourself in any way by the types of companies you can invest in?
Well, there's equity issues are one thing, but there is research that say that women are better stewards of capital. I mean, there was a big study put together in 2019 by Boston Consulting and Mass Challenge that said that, and that's a huge data set, that said that women entrepreneurs generate 2 times the revenue per dollar of capital invested. So there is research that say that you want to look at diverse founders. And maybe, I don't know why that is exactly, but maybe necessity is the mother of invention. Think about it that way.
One thing I do think about when it comes to angel investing, right? You can throw a little bit of money at a business, right? And it really can kind of get going, especially in this environment where technology and social and so on and so forth is so much a part of sometimes a business getting going. Having said that, how many of the angel investments that get made in your world, how many of them actually turn into something that either gets sold or is fairly profitable?
So, in the angel business and the venture business, we know that about 35% of companies don't return all the capital. We know that. Yeah. In venture, I've seen studies that said it's, half. In our 20 years of experience, we've had just about 30% of companies who haven't returned capital. But the rest of our companies, in fact, I looked at it just the other day, of all the money that we've invested, 100% of it has come back in aggregate to our investors, and there's unrealized gains in the existing operating companies of about another 79%. Yeah. And on average, our companies are still only a couple of years old. So the thing, though, is that's across our whole investor group. So I can't give you a number for any specific investor, unfortunately.
Joanne, we're seeing so much energy around AI right now. And you've certainly, you and the team have made some investments in AI-focused companies, certainly. But when you look around the landscape, what's exciting to you right now?
Well, companies using machine learning and AI, that's big in angel investing, but not the large language models that take billions to affect. Most of the stuff that we see, and a good, 10% of our operating companies are machine learning or AI companies, but generally we're looking at companies that are solving a very specific business problem or improving a specific business process. And that's, been part of our environment for at least 5 years. I can give you a couple of cases. We have companies that do scheduling, telephone or text scheduling for real estate companies, for healthcare providers. We have companies that do collections. We have companies that do image creation specifically to match a brand. We have companies that use machine learning to do antibiotic resistance prediction. So, but they're using the company and the company's clients' data. So it's not these things where you need billions and billions to get going.
Joanne, really appreciate you joining us once again here on Bloomberg Businessweek. Joanne Corkran, co-chief executive officer and managing partner over at Golden Seeds.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, TikTok, everybody. Just about 18 minutes left in today's trading session, getting ready to wrap up the week that was, and definitely one where we saw a different tone compared to what we've seen over the last 3 weeks, right? I think that we've seen stocks down on a weekly basis, but we are on track for the S&P to see quite a healthy gain, if you will, in the trade. Just pulling it up 2.8% to the upside, and that was after 1, 2, 3 weeks of declines. NASDAQ 100 outpacing even that on a weekly basis.
You just set that up very well.
Thank you.
I just want to say thank you.
You are welcome.
Okay. Well, Katerina Simonetti is Senior Vice President at Morgan Stanley Private Wealth Management. Given everything that Carol just said, Katerina, are we kind of out of the woods with this sell-off that we saw in April?
Well, Tim, Carol, thank you for having me on, and happy Friday. And it just goes to tell us that market is always looking for a reason to stay optimistic, even though, of course, when we look at the market performance over the last 3 weeks, it gives us the pause at the very least as we are entering the second quarter of earnings. And as we're questioning ourselves whether the earnings are able to sustain and support the valuations that are so high. Market had a tremendous increase last year, especially towards the end of the year, on expectations that we are going to see lower rates quite quickly, and seeing inflation not quite at the numbers, nowhere really close to the 2% mark that Federal Reserve was hoping to see, is putting at question whether we are going to see rate cuts, as soon as we expected.
Is it all about rate cuts? I mean, I guess it is. We certainly play. It's our favorite, as Tom Keene likes to say in the morning, it's our favorite parlor game. Like, what's the Fed going to do, what it's not going to do. But having said that, as long as we have, we were kind of freaked out, if you will, with a lower growth GDP report, backward looking, higher inflation print. We got another one today that kind of says, yep, it didn't come in higher than forecast, but it does remind us that high for longer when it comes to inflation. Having said that, around these conversations, the economy continues to, move along and survive. The IMF raising its forecast for global growth. I don't know. Is there something that says maybe the world, certainly the publicly traded world, is figuring out how to kind of operate in this higher rate environment, which is still kind of more historically in line than what we saw when it was a zero rate environment?
You're absolutely right. And we need to switch the focus from this mathematical, is Fed going to give us 1 rate cut or 2 rate cuts, or are we going to get 5 rate cuts? And we have to look at what functioning in this high rate environment is going to mean for the profitability of our companies, what it is going to mean for consumer behavior, who are going to maybe change their normal habits, normal spending patterns because of the interest rates. And we have to look at it from every which way. And Fed absolutely has a very difficult decision in front of them. They've set the expectations, and they've said time and time again that their next move is going to be a cut. But at the same time, they also pride themselves in that data-driven approach. And as we look at the earnings, the real focus should be whether current earnings, and we're seeing them here in the second quarter, are going to support the valuations that we see in equities, and whether our companies are going to be able to stay profitable in this potentially higher for longer environment.
So, Katerina, as the narrative has changed a little bit, and we'll get maybe possibly a tweak on that narrative, we will see when we get the next Fed meeting and decision next week, right? That is certainly a focal point. We get a jobs report after the Fed meets next Wednesday. Having said that, are you tweaking at all investor portfolios, client portfolios. I understand invest for the long term, but that doesn't mean you don't do some tweaks here and there. So what might they be in this environment?
Well, of course, and tweaks are perfectly normal. First and foremost, we're of the mindset that no quarter or no month, should ever be, driving force behind changing the total large picture strategy. But with that in mind, the tweaks that we're doing is focusing to quality, looking at energy, industrials, materials, making sure that no one sector in our portfolios is overvalued. If there is a possibility to rebalance and take profits, because we have positions in sectors that have done so well over the last 18 months. And this is a perfect opportunity to take some of those gains off the table and replace them, put them into the areas that have not performed well, that are positioned to deliver these, good results.
So energy, by the way, it's your second top or best performing major industry group in the S&P 500 this year. There are 11. Real estate is the only one that's down for the year, and that I would assume to some extent maybe on the rate environment, but down about 9%. And also concerns that continue certainly among some of the office property area and commercial. But energy is up as a group almost 15%. So, is that good? That's pretty good for year to date. And here we are at the end of April. So you said you like energy. Do you continue to commit to that space?
Absolutely. It's one of our highest convictions. We think that energy is well positioned, not just due to the fact that, we're seeing current oil prices and production levels, but also due to the valuations and competitive positioning, of the energy companies. We think that there is, some additional growth in that sector, and just the dividends. If you look at the income generating abilities of the energy companies, they play an essential role in the portfolios.
So where do you not want to be, Katerina?
When we look at the broad picture, we think that rate cuts are coming. And historically, there is a positive reaction by large caps, especially the dividend-paying stocks, that immediately following the rate cuts. And about 6 months, maybe plus, we also see the rest of the market kind of like, coming along. So we like the shorter term positioning of the large caps, and we like longer term positioning of small and mid cap. We also tell investors to take advantage of the higher rates, take advantage of the higher yields, really focus on their fixed income portfolios and make sure that they're well diversifying, that they're taking advantage of the high yield, of preferreds, of municipals, because rates are high right now and we're getting very comfortable with them, but they're not going to be here forever. And this is a great environment. And over the last couple of weeks, we also have seen declines in the prices and fixed income prices. So not only the yields are attractive, but there are also some really, interesting buying opportunities out there in the fixed income space.
All right, Katerina, thank you so much. Have a great weekend. Katerina Simonetti, Senior Vice President at Morgan Stanley Private Wealth Management, joining us there in Philadelphia.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.